Good morning, everybody. Welcome to the Flow Show. Another fun-packed morning of news, views, and analysis, no doubt. I hope you're doing all right. Morning, Stel. Morning, Kay.
News, views, and booze. No.
Yeah.
Good morning.
Without the booze, unfortunately. Not enough booze. There's never enough booze. Hey, how you lads doing? All right?
Not too bad, thank you. We're making our preparations for our London trip, so I'm happy about that.
Yes.
Hopefully, going to catch up with you guys.
Yeah, I'll book my train.
Excellent.
We may have to do a little time adjustment on the Flow Show for that one. And yeah, just after I booked my train up, there was a landslide and it's knocked out half the line running into London from where I am. So all the trains are not running at the moment.
Oh wow!
So we're hoping that gets fixed in time. Otherwise, I might be coming on my bike. I'll have to pedal up really fast. We shall see. But yeah, we're having a little shindig up in London, meeting Stel hopefully, and some of the other chaps and chapesses that we know in the market. Michael Brown is coming out, and actually Michael's going to be popping into the Flow Show tomorrow morning, so that's going to be a little surprise for you guys.
Awesome.
But yeah,
Nice.
if you're around the London area, 7th of February, get in touch and you can come and meet us for a drink. And yeah, looking forward to it. I've been uptown for a good while now for a drink up, meet some of the older folks. But yeah, looking forward to it. Yeah, Brian, just hop on a plane and come across, mate. More than welcome. Right, let's get stuck into it then. Japan is going to decide whether it downgrades COVID status on Friday. Further moves towards their coming out of the pandemic. Now, Reuters looked at a poll did a poll of Japanese firms, and most big firms are going to heed the Prime Minister's call to raise wages this year. 53% are committed to wage increases this year. That may not be as high as we would like or the government likes, but it's a start. And obviously, if they're big firms, then it's going to have a big sway on potentially on inflation if wage hikes are of the big kind. And on that survey, also 81% of firms are pessimistic over the next 3 months. So some signs of good sentiment coming further there. Over in Australia, some fun and games with the jobs report. And this really has added to what we've seen in the Aussie dollar, as you can see on the screen there, a big, massive pullback from after hitting those highs, getting into the 70s and all the way back under 69 now. And the Aussie employment was one reason that added a bit of fuel on that fire overnight. The employment change for December was down 16.6k. It was expected to be up 25k. And the prior month was a strong 64k. The unemployment rate rose to 3.5% from 3.4%, was expected to stay unchanged. And that comes as well as a participation rate dropped to 66.6% from 66.8% prior. Now that can sometimes, depending on how it's calculated, have an effect on the unemployment rate. If the participation rate drops, the unemployment rate can drop also. So the fact that it went up while that dropped shows how negative this report perhaps was. On the revolving door, the full-time employment change was up 17.6k versus let's get it on the screen for you. That might help so you can see what I'm looking at. Where are we? Oh, all over the place. Right, so you can see the unemployment rate there. So as I said, the full-time employment change was up 17k versus 34 prior. Part-time did a lot of the damage by the looks of it. It came in at minus 32.2k versus plus 29.8k prior. It's December. You've got to maybe think there's a bit of seasonality to this, particularly considering the change in the part-time employment, which conversely you might think would go up in December if people were taking on extra staff to cover the Christmas period. Usually you see it jump in a month like November, December, and then fall out of bed in the new year. But there's a bit of a difference there. Overall, I don't think the unemployment is as bad as the market has made it out to be, particularly, as I say, the reaction in the Aussie dollar. But sometimes if you've got a snowball rolling one way already, it doesn't take much to push it a bit further. I think that's what we've seen in the Aussie dollar here. But we'll talk about that in more detail in a moment. Over to the Norges Bank, and they left rates unchanged. I'll let Kay come in on that. Any significant headlines from that, from the statement or anything?
No, not really. Well, they are saying that the outlook for the Norwegian economy has somewhat deteriorated, but they are still expecting to raise the next 25 or so BPs in March. So it's all pretty much going according to what they've been saying in December. So there's not much of a change, but in the meantime, yeah, Norwegian kroner is dragged around by sentiment, and the Norges Bank still selling, although less, Norwegian kroner every day. And yeah, for the rest, I think Norwegian kroner is still going to remain on the defensive for now, unless those gas and oil prices start to really ramp higher again.
Stel, any thoughts you've got? I know you like to play a bit of knock.
Yeah, I do. I mean, they didn't say anything new. The plan is still for them to hike another 25. Is it on the next meeting or something like that? But, you know, I guess they're following the whole the global trend of acknowledging that things are getting worse, right? For the whole planet, for pretty much every single country. So they're going to do that. They're going to err on the side of caution. Like Kay said, they keep selling the crown every, you know, they have a schedule, right, where they sell their currency. And isn't it nice? Everybody wants your currency. You sell it, you know, for other to keep it in check, and then use the proceeds, you know, dollars, whatever it is that you buy to buy a crap load of stocks. Anyway,
more Apple. Buy more Apple.
Yeah, overall, nothing new, unfortunately, from Norges Bank. That's why the kroner is not really doing that much today. I mean, it's been weaker today, but that was before the rate decision.
Yeah, definitely. Right, coming over to Europe, or further into Europe and the ECB. ECB's Villeroy repeated that the terminal rate could be reached by summer. And then what we've had is more pushback from some ECB members to the stories we got this week. I don't even remember the story that the ECB may dip to a 25 pip hike in March after a 50 in Feb. That got a decent bit of pushback, and the ECB bonds have been coming out in force. ECB Ren saying significant rate hikes are justified in the near term to keep inflation expectations under control. ECB's not was even stronger. ECB will do what's necessary to deliver on its mandate and sees no signs of underlying inflation pressures abating. Market developments of late are not entirely welcome, and I would take our words quite seriously. The ECB won't stop after single 50 BPs hikes. The ECB is only focused on the risk of doing too little right now, and the ECB will be in tightening mode at least until mid-year. So very, very strong pushback by some ECB members there to those headlines that Bloomberg kindly dropped on us the other day. Have they got a bit of communications problem again, guys, with the market, you know, taking the sources pieces to heart and then forcing the ECB to come out again? You know, look, this has been something the guards banged on about, these leaks and these little sources drops. She hasn't managed to stop them, has she?
No, it's weird, right? They, especially the Fed and the ECB, they keep having to reiterate the fact that they're going to be hiking by more than the market expects, and they're going to be staying at high rates for longer. I mean, I don't know what to make of these leaks and these pieces written by people, and I just don't know what to make of it anymore. It's so easy, unfortunately, for such posts or headlines or whatever to move markets, right? You kind of think, if you're cynical enough, that they're being done on purpose, but I really don't know what to make of it. I don't.
Yeah, I mean, I think the ECB are, we've talked about financial conditions and, how that transmits central bank policy. And we've noted, obviously, that financial conditions have eased in the US and US markets and the like, and that it hasn't been a real strong pushback by the Fed. I think it's going to be different for the ECB. They always want to make sure their exact policy is being transmitted through to the ground level. So they will not be letting financial conditions do similar to what the Fed has done. If there's any pushback from the market, call them the pivoters for the ECB or whatever, they will come out fighting it because it's their way, that they are adamant, this is our policy, this is what the market needs to translate that as. So if we're going to get a similar situation, we should expect to see a stronger response from the ECB than perhaps we've seen from the Fed so far. So coming over to the US and a slew of data out yesterday. Lots of data out yesterday. Starting off with the NBA. This one's a bit funky at this time of year because it's a weekly number. It was no surprise to see activity dropping into the end of the year. No one moves houses, gets mortgages over Christmas, etc. And we've seen a very strong bounce back in the first full week, I would say, of the new year. 27.9% jump in mortgage applications there, jumps in all the indexes underneath. Not to read any much into this one. It may be that it continues into the new year. We'll see. We know that it's been on the slide pretty much all year. But conversely, looking at another housing number that was out yesterday, the NHAB, that jumped up a tiny bit. I'm not sure if it's on this candidate. There we go. That's another one that's been on an absolute dive all year, and it's managed a bit of a dead cat bounce coming into January, up to 35 from 31 prior. Again, could just be a bit of New Year's pickup in trade. We'll keep an eye on that for the housing market. For the other numbers, PPI confirming the direction for inflation. Core PPI 5.5%, worse than expected or lower than expected, off a 6.2 prior. PPI headline, again, big dip, big miss of expectations, or lower than expectations, 6.2 versus 6.8 expected, 7.3 prior. So have we got the peak inflation in? It looks like it definitely is for now. We have got a trend lower in inflation. What we have to see is how far that comes down to, perhaps before it starts steadying. This could just be a bit of a blow off the top, as Stel's mentioned plenty of times. There can be some big adjustments as other components from the prior years drop out. Everything's got to do almost twice as much just to maintain what we saw last year in inflation. So again, that's fallen into the Fed's hands of lower inflation. Retail sales not good at all either. You would expect November and December to be the strongest months of the year, with everything that goes on, Black Friday sales, all that sort of stuff, Thanksgiving, Christmas, you name it. Usually these are the strongest months of the years, but if you take them all together at the moment, it's not looking too hot for the US consumer right now. So that is something that needs monitoring. Is that going to lead to a bigger pickup in debt levels, perhaps, if consumers are struggling for money to spend? PPI out of Canada as well, pretty much following the trend, coming lower as well. No real surprise to see that. We're seeing it across the globe. No need to change our thoughts on what happens there. Industrial production, again, another soft number. These are not soft landing numbers coming in now from some of these metrics. We know it's very dicey in the PMIs and stuff. This is more harder data, as they like to call it. Bit behind the PMIs, but it's now starting to reflect those as well. The jobs market still remains the sword of Damocles hanging over the difference between a soft and hard landing. Business inventories there, not much to talk about, coming in as expected, a touch higher on last month. Now we had this other piece, the Beige Book, which is like a survey of different Fed member or Fed regions surveying their businesses within their jurisdictions. And the Beige Book, some of the conclusions were that wage pressures remained elevated across districts, although 5 reserve banks reported that these pressures had eased somewhat. And on balance, the contacts, these are the guys the Fed people speak to, generally expected little growth in the months ahead. So pretty low sentiment from there. And also, obviously, we got some Fed members out. Fed's Bullard spoke to our old mate Timmy Leaks. He said inflation will probably recede in 2023, but not as fast as financial markets expect. Policy is almost restrictive, but not quite there yet. He did say that the prospects for a soft landing have improved markedly, but he did come out with a rather dovish comment for Bully Bullard. He said, if inflation falls dramatically this year, it could lead to lower recommendations for the policy rate. Now, he's been one who has wanted rates, get them up, keep them up. So this is a bit of a curveball from him on that, in that if it does fall dramatically, then they may look at recommending a lower policy rate. Not a voter, so take his comments with a pinch of salt. Fed's Mester said rate hikes have begun to quell US inflation. Another victory lap coming from her. Fed's Harker repeated that he supports moving to 25 pip hikes. Fed's Logan also saying support for a slower US rate hike pace, saying tight labour markets must be brought into better balance, need to raise rates until evidence seen of slower inflation. And slowing the rate hike pace further ensures the best decisions are made. And it's elevated services inflation that's coming or showing, and it's a symptom of an overheated economy. And further to the Fed, poor old Powell has tested positive for COVID. All the Fed enter the blackout period on Saturday as we enter into the FOMC orbit at the end of the month. So from Saturday, it all goes nice and quiet. I love that time of year when it all goes quiet and there's no speakers every 5 minutes. And just to add to the bubbling of the debt ceiling stuff, the White House Press Secretary Jean-Pierre says there will not be any negotiations over the debt ceiling. So unfight to come on that. And that's all I've got from the headline front. I don't know if you guys have got anything you want to throw in.
Not really.
Nope. Anything from UK?
No, I think you've done pretty much the rounds of what there is to look at. The one thing I want to note though on Japan is that surprisingly, the last week's data of foreign bond buying have been positive, where they should have been selling shitloads, but they are positive. So that's a little out of sync with actual price moves in the yen, and also the trade balance, although a tad better than prior month, came in negative again.
Yeah, it's a bit of a revolving door on that one, isn't it?
Those trade numbers and things in Japan are still not looking up really. But of course, tonight we will have it's tonight, right? We will have the Japanese CPI coming out, so that could get the ball rolling for the yen again later today. Market will be scrutinizing what's coming out there to see if Kuroda is really being too stubborn, and if it comes out higher, then the market will likely start to try and buy yen again. In the meantime, I could see a bit a bit more correction. Perhaps we tried below 128, failed again, and also euro yen is showing a bit of resilience down below 138.
Yeah, yeah.
So, but yeah, the big rendezvous will be tonight, Japanese CPI, right?
Yeah, exactly. And you know, yesterday's price action was very important in my opinion. You know, we've been speaking about this 127 level as a big level that possibly came into play, a big longer term level. You know, we got the fib action around here was a prior area of support and resistance. You know, we flagged this up before we even got here when we were well in the 130s that this was a potential area. Now, yesterday's price action to me is looking very important. This low here and even to this low here today. When you get a big level like this, if it's going to be defended, it's going to be defended just above it. Now, one area was around 128, a decent area away. That lasted as support for a bit, and then we got the break yesterday. But that we couldn't get down to this low again can or could be very significant, because it potentially suggests that the market has done what it needs to do regarding, let's call it pricing what they think the Bank of Japan's going to do, where the Fed's at, you know, all the fundamentals, that sort of thing. So we got a slew of bad US data. You know, we're already on our way anyway. The fact that all that couldn't get us down to this low, as I say, could be very significant. These are how strong bottoms are made, when you see this stepping up type of action. Now, we've been talking also about the CPI case, just mentioned it. We've been speaking about it all week. It's something I've been looking or waiting for, particularly after we got the Bank of Japan. And if we can't break that level, if we test down here, let's say the data is really strong, it comes in, that core is expected at 4%, let's say it comes in 4.1, 4.2. If we can't break this level again on that sort of data, that's going to solidify my thoughts that we have found a bottom for now. The market is happy with what it's priced. It doesn't want to push the boat out too much further on sending this lower, buying the yen. And that's going to be significant, because it means then we're potentially going to get a strong bounce back into the 130s, I would expect. And maybe we're going to look to see if we get up to 133s and maybe even that 134.5 level that we've been keeping an eye on for quite some time. So this is where price action becomes king, okay? Because that's going to tell us the story. Now, if we do break this level over a strong CPI number, it's going to be important that we keep that break. If it's a big data number and we just get a quick flush through and back above, again, the same scenario applies. The level will become a level again. And if we can't hold under, then again, we might see a push back up. It's the market saying, right, we've had a quick flush out of that on the knee jerk on strong data, but it got back above really quickly. Then again, I'm still going to be looking for a push up, maybe well into the 133s. On that basis, I would be looking to chop out a good chunk of my shorts that I'm currently running from the 131s, because I might as well take some profit if we're not going lower and look to reload at some better levels instead. So it is going to be very important, this CPI data. The price action over the next few sessions is going to be very important to see what happens at this 127 level. Kay, what are your thoughts? And Stel, I'll bring you in to have a look at your charts.
Yes, sir.
Yeah, exactly. I think for the sake of those long yen, I hope that CPI does not come in lower, because then the market will have a little bit of rethink to do, and Sake-san is going to win half the fight. Yeah. And I could really see the yen weakening, perhaps more than what it did on the Bank of Japan over the next sessions. But yeah, it's going to be an important data. Even hitting 4% as the expectations are, that's going to be food for the yen bulls, I think, to try and force the hand again. Now, two other things to note on those Japanese companies, right? Who are planning to raise the wages. I'm a little disappointed there are not more. On the one hand, and also a part of those companies will likely only raise. It could be below the CPI, which means that real wages still will be going down or be stagnant. The other thing on which is interesting, because we mentioned the other day that Uniqlo is ready to raise wages by up to 40% for some employees. I spoke to my son who's living in Japan, and he said Uniqlo is seen in Japan as a black company, meaning that the working conditions, working hours, and pay are well worse than for any other company. So Uniqlo is not seen as a very good company in Japan from that side. So raising wages over there is on the nominal side of things is probably a very good. It's a good thing, whatever happens for the employees, of course. But it's he says it's probably going to be more seen as a catch-up of normal working conditions somewhere else. So we have to look at it from both angles, right? And lastly, we're going into the Chinese New Year next week, and I've written a small piece on it. Well, just my quick observations in the room, and I've put it on Twitter as well for people to have a look at it. It used to be that dollar yen or yen actually put in a peak during Chinese New Year because there were like really cargoes of Chinese shoppers dropped in Tokyo and loading up on whatever Japanese they could put their hands on, whether it be clothing or Japanese household appliances and everything. Since the pandemic, that dropped away, of course, and even though Japan is trying to reopen, the difficulties of getting traveling documents is likely going to still put a damper on whatever Chinese numbers of travelers could hit Tokyo next week. So I wouldn't say it's the main driver, but if you look at seasonals, for people looking at seasonals, it's perhaps worth keeping an eye on the traveler numbers next week from China into Japan. If they're really underwhelming, it may be one factor why yen is not really supported. But again, it's not a main data. It's not a main fact, and or it could actually be positive yen if really there are bigger numbers traveling to Japan. So that about Japan and the yen right now for me.
Yeah, and obviously Kay's right. You know, if the data does come in between expectations or lower than expectations, or even prior, if inflation isn't rising as hard as expected, we're naturally going to see dollar yen rallying again, and that will solidify these lows once again anyway. So basically what I mean to say is at the moment I'm seeing that there's a greater risk of seeing a bounce in dollar yen right now than there is of seeing it drop further. And while that sentiment is in my head, I have to look at my trades, manage my trades accordingly. If that means getting out of some and looking to reload, so be it. But we have come a hell of a long way, as you well know. And we got to stop somewhere, be it temporarily or otherwise. And just before I hand over to Stel, a quick look, because we were talking about this yesterday. And I know myself and Kate tried the break trade.
I did too.
I had a buy stop. Were you in as well, were you?
Yeah.
Yeah. Oh, yeah, you were. I remember. Yeah, you were as well. So we all had a little try.
The bookies had a little laugh on our break trades because between the three of us, they raked in a few. On that one.
The brokers made their money on us three yesterday. But Kay was in at 78. I was in at 80. Where did you jump in still?
I was in at 80, out at 60. But this this for me shows why you have to be diligent with your stops. You have to have your plan, because if I wasn't out at 60, it would have been another 70 pips lower. So if you're not disciplined, you will make a small loss a big one, and you really don't want to do that.
Yeah, I had a 45 stop on mine, and it dropped to 48. And I was like, oh, just missed my stop by a whisker. It got back up to 62, and I went, thank you very much. Yeah, you can have it back. So I lost 18 pips on mine. Kay lost a few on his. You only lost a few of yours. But, we'd love to come in today and it's trading at 109.50 and say how great we are. But also, we covered exactly what may happen at these type of breaks. You can try them. I was always worried that, there was a lot of resistance not too far above into 109. We couldn't even get into 108.90s. So that shows that there's still strength in resistance up here. But we covered all the angles yesterday. If you try these sort of trades, you keep your risk low. We lost a few pips. We didn't end up down here at 107.80s going, oh shit, what do we do now? We lost a bit. Next time, maybe it breaks and maybe it goes. It doesn't matter. We kept the risk down. If you were short, fine, you've had a good day on it, and well done to you, because the level pretty much held, so it stays in play. So yeah, just wanted to show it doesn't always go right when you try these things. We're not infallible. Traders such as Stel and Kay and myself, we do lose trades, but it's how we manage those losses, and we try and keep those losses to a minimum. Right, on that note, Stel, do you want to grab the control?
Sir. I'm taking the ship.
Taking the ship. Strapping tight.
That's the one. There we go. So you're talking about you were talking about dollar yen. Why you think the chances are higher for it to rise first? And I think there's a reason here that supports that. I always look at yields to start, and before we talk about what's happening in general, look, we're heading into support. We have the 200 DMA. We have this was kind of a descending channel. It got broken, got retested. Now there again. So it could be. If you ask me, I think the chances are now for a bounce. How high, I don't know, but I think the chances are increasing. And look, 10-year US is below 340 now. Big curve inversion. Fed members are still telling us that they're going to be hiking. So what are we seeing here? What's the market telling us? I think the market is telling us that inflation is going to subside quickly, and that the Fed is then going to be led to ease. That could well happen. But again, as I was saying yesterday, I think it's a lot priced in now. I mean, it's difficult to be. You definitely don't want to be getting long bonds here. I mean, obviously, if you were long before, you've done well. But chasing it here with support here in yields, and the dollar also coming into support, I really wouldn't want to be doing this. But then again, having said all that, the numbers have been, apart from payrolls, numbers have been pretty dismal. We get more numbers today, housing data, if I recall, and inflation is dropping. It's dropping at a decent pace. Will it continue? I think that's what the market's waiting for. But at the moment, yields are still on a downtrend. As I said before, I think there's a good chance we break higher from here, at least in the short term. I think we could easily head towards 350, 355 again. And we're getting a bit of risk off as well. So anyway, this is what I think about yields. The dollar is interesting. Actually, let me go to euro dollar first. We were talking about this 108.70, and we were talking about how important it is to have your stops. I got taken out for 20 pips, and I'm taking a step back now on this, but it just feels like yields want to turn higher, or at least the probability, I think, is now on that side, which means that we could see the dollar finally strengthening a little bit following weeks of weakness. Nice. Now the question is euro dollar. I wouldn't want to be long the dollar against the euro, because the ECB is still hawkish, and we're getting more and more ECB members talking the hawkish talk, and I really don't want to get ahead of it. So if I wanted to get long the dollar, I would probably choose another a different pair. Cable, not yet. If we get close to the highs there, 24.5, I might do that. But I'll probably pick something like, good question, actually. Dollar Norway could be, yeah. Dollar Norway is a good candidate with relative weakness of the kroner. I think that we could see a breakout. Look, we have the 50 and the 200 DMA crossing here, or attempting to cross. This is if it crosses below, that's a not the golden cross. What's the opposite? I can't remember what it's called. Death cross. Death cross. Yeah. But I think we could see the kroner is usually quite volatile. So if the dollar rallies, that's one that could definitely outperform. Now the big question that everybody's asking is, what about stocks? Because same as yields, we're pricing a lot in stocks as well. We still haven't seen. It's a very orderly move lower from the highs as the Fed was tightening rates, as the dollar was strengthening, and you can bet that if yields start grinding higher again, we're going to see a move lower in stocks. And I've talked about this chart before. I mean, this was a really nice test of that trend line, and we're lower. It's if you want to be long stocks, the upside is very limited in my opinion. It's 4K. If that, but I think on the downside there's more scope, especially if yield starts rising and the dollar starts rising as well. So something to be wary of. There seems to be a lot of how do I put it? A lot of euphoria in stocks. People are saying, buy the dip still. I still think that the dip should be bought, but not at these levels. I think we're going to first test these lows here, 3,600 or somewhere there. We're not that far away. It's only like a 10% move or something like that. So it's not. Do
you think this stock move is reflecting the data? Because bad data usually meant that stocks went up. Have we finally made the switch in that bad data is going to be bad for stocks, do you think?
That's a good question, because the initial reaction to the bad data was stocks higher, but then we just yesterday we just turned around, and I think we're getting to that point, yes, because bad data means easier monetary policy, but bad data also means lots of people getting fired, corporations not doing well, retail sales dropping, people not spending. This is not good for stocks in general. Stocks are driven by earnings, and earnings are started to not look good. Obviously, stocks are also driven by buybacks, and buybacks have been a major force over the past 10, 12 years. And it's been a huge rally on the back of buybacks, because corporations could borrow at very, very low rates. I mean, even Apple was borrowing with a cash pile of, what was it, 350 billion or something, some ridiculous numbers, and they're still issuing 10-year bonds because, hey, they could at very low levels. So as this has been reduced greatly, obviously, because rates are going higher. So that's out of the question, out of the equation at the moment. So yes, I think that falling stocks with worsening economic conditions is a natural move. We've forgotten about this over the last decade or decade and a half, but this is what usually happens. So, if the Fed stops messing around too much, then price discovery should be lower in equities, at least as long as fundamentals in companies, you see, as long as these fundamentals are worsening, you see even companies like Apple and Google and Meta and all those, they're struggling, and there will be a time, Amazon, all of them are going to struggle at some point, right? So there's going to be a correction. We can't abolish corrections. So having said all that, I think stock indices in the medium term, and by medium term I mean multi-year horizons, they should be bought on dips. Any meaningful dip, I think, it should be bought. It's very simple. It's inflation, right? Inflation, and I'm talking about asset price inflation. I'm not talking about other measures. I'm just talking, companies behind them, they have real assets behind them, right? They're, unless you're talking about companies like Instagram, but or whatever. But the purely digital ones. But in the grand scheme of things, the indices are going higher. I mean, that's been the case for decades. So yeah, I think we should be buying dips, but I don't think we should be buying them yet. I'm definitely not buying the dips yet. First I want to see a test of 3,600. I've said for ages and ages, 3,300 is really where the level where I'm going to start getting quite aggressive. So I wait for that. And it's a similar thing with the metals. We talk about this for ages and ages. And look how many times silver has tried to hit that 2450 level. It failed again. So I wait. 2220 is my level, or 2450, whichever one comes. Until then, we're going sideways. Gold is trading a lot better. This move over the past few days, you could say it's a consolidation move. Yes. I mean, this is bullish. If you look at this chart, it's still very bullish. You're going to have a correction at some point. What's going to bring a little pullback? I think if yields rise, metal is going to come back a little bit lower. It's a natural reaction. If the dollar rises, same. And yields and dollar usually go together. So, a pullback towards, the low 1800s, maybe. I'm going to have to do some, actually, let's see. Hold on. Let's see if this was the high. 1850, 23.6, or really probably 1800, 1805. Look, we have a couple of lows there, a high here. Yeah, there's this scenario of interest here around 1805. So, we could we get $100 lower in gold? Of course we can. And I think that will be a nice pullback to start loading up again. And it's a similar story for silver. I think 50% fib, it was a high here, was a couple of lows. It's a nice little area. I'm going to remember still have half position from 20.5. I sold that the other half at 24, actually 23.98 if I'm mistaken. I'm not mistaken. I have to look back. I'm going to buy that back at 22.20 and see. So, yeah, so that's what I think about those cryptos trying to rally. I mean, they had a magnificent run here, especially Ethereum percentage-wise. I mean, that was, 1,200 to 1,500. My God, that's big. That's like 30%, isn't it? Anyway, big old move. And but still, if you zoom out, we're still kind of in a very, very long sideways consolidation. If we do get yields rising, dollar rising, you can bet that Bitcoin is going to be challenging these lows again. So for crypto fans, we get more, more liquidity, more volatility. Coming back to cryptos, they'd been dead for weeks. So here you go, an opportunity to make money, but also to lose truckloads. So I'm not in it. I'm not in it at all. Anyway, that's it roughly for me, just a broad view of things, and hopefully it's helpful.
Thank you very much, mate.
I think on gold, I think we have to look at the numbers, what China and Russia are still buying.
Yeah.
Once they stop buying, perhaps then there's a chance of a bigger setback. Of course, we have to look at yields, which are going down. And then, and on silver, it's still like the economic data are not really supportive for silver to explode, right?
No, it's an industrial metal, right? Yeah.
Yeah, we need a bit lower yields, but an economy that doesn't falter completely, right? If we get an economy that at least muddles on and doesn't worsen further, like i.e. escape from recessions, really. If we really get a soft landing, I think silver could start to outperform gold, but we need time to let we need to let time do its thing, right? And that actually coincides as well with the question that Ryan had about are bad data finally showing into the stock indices, and I think we are very close to that now, and the proof is what we've seen over the past couple of days, right? Yeah, we had the tech level around 4K in the S&P, but and I don't know why, because I was off yesterday. The dollar reacted so violently higher, which again is more correlated with the S&P. But I do think if you look at it on hindsight, take away Aussie and Kiwi, the rest of the currencies is more trading a little bit risk off, and the dollar is not really higher. So we may be close to that inflection point we were always talking about and looking out for, that finally bad data are going to be bad for asset markets.
Yeah, definitely. And Mike raises the point, you know, the retail sales number was affected by the bad weather and heavy discounting. Well, yeah, we've spoken about the bad weather effect, something to keep in mind for the next NFP. But yeah, second point, heavy discounting. That, you know, why are firms heavily discounting? If they're forced to heavily discount, it means they're not getting the footfall, they're not getting the orders, the customers, which is a bad signal, any which way you look for it. And that's the sort of signal that can cause what looks like deflationary pressures, because if prices are forced to be cut back really hard in you know, the retail side of things, it can give deflation impressions, because then we start seeing negative inflation numbers coming into the mix, you know, maybe on the month and that sort of thing. So, you know,
that wouldn't be a terrible thing, right? I mean, after what we've seen the last year and a half, wouldn't be a terrible thing to see.
It's terrible if it goes too far the other way. So if you you know, remember, inflation is falling, but it's still all positive numbers.
Yes.
You know, that's the thing. We're still all in positive territory. If you start seeing some negative inflation prints, that's when it starts getting a bit messy, because all of a sudden you find that that's if you like, the starting point for a big drop in global activity, because it all starts with the consumer. As soon as the consumer stops spending, then the retailers, you know, start discounting. Then they start wanting discounting off their suppliers. So manufacturing starts discounting, producers start discounting. It goes all the way down the chain, and then you've suddenly gone from an inflationary trend into a mini deflationary trend, and that's bad for the central banks, because then they're running from one side of the boat to the other. What they want is a nice, smooth transition of inflation still remaining up, but coming back lower towards target, not going into a nosedive. But that's the fine line central banks have to watch for and walk. And I'm not suggesting it's going to happen, but it starts somewhere. And when you get heavy discounting across the board, that's when it can start to impact. But anyway, that's a potentially fictitious outcome or outlook. I'm just pointing out there. Now, just quickly before I let Kay come in, if he's got some bits and bobs to show, we have got a very healthy discount. Speaking of discounts, this one you may be in on the ForexAnalytix platform. As you can see there, buy 1 month, get 1 month free. We've got a 30% discount on semi-annual and 40% discount on annual subscriptions. As you can see there, this is only in place until the 27th, so you haven't got long. If you were in doubt about taking on or coming on board and joining our chat room and the platform, you can get in at a very decent price. And we also keep those prices there. So if you subscribe at those prices, we don't then hit you with a price rise 6 months.
Yeah, you're grandfathered. Yes, exactly.
You're grandfathered in. You hold that price for as long as you remain a subscriber. If you want to get ForexAnalytix for free, you can do so by joining the Traders Funding Program, where depending on the size of account you can get ForexAnalytix for a certain amount of months. I shall pop that link in there for you. So if you want to have a look at that. Yeah, it's been a very successful program so far. Lots of people passing their assessment. Some are taking a couple of goes at it. They need to work on the discipline, and they have done and have since passed. And a lot of people, more importantly, getting paid out on it, because that's the end game for all this. So if you want to check out some details there, I've put the link in the chat room there. Kay, do you want to have a whistle-stop tour of anything you're looking at?
Oh, we lost him.
Oh,
He's muted.
there?
You're muted.
Muted.
Oh, I'm muted. I
Yes.
was muted. Sorry, guys. Yeah, I can do a quick tour. If you, yeah, I'll take it over.
Stop it down.
So just a quick reminder of the importance of those levels in the dollar yen. So first of all, there's this really multi-year wedge where the support line also comes in around 127.5 right now. And then you have what we can see, right? You have the either the low of the pandemic low to the high. The 50% is around 126.60. But what's I think more important is really again when the dollar yen really started to go higher. And that comes in the 50% around 127 and a quarter. So really, this is the magic level right now on the dollar yen. I think for the more medium term, and perhaps CPI tonight will be enough to tell us whether it's going to hold or not. If you have any yen positions, it's for sure worth staying up tonight. For the CPI. If in turn we start to go back, and then I have to go on to shorter time frames. If I'm going to go even shorter than that, which is not my usual, but okay. We need to get back. So the first little level is already around 128.90. Then you have the 129.40, which we already mentioned, and then we're coming back into more. Yeah, you got the 130, where we still have the weekly top of the Ichimoku cloud, by the way. That is exactly at this 129.95, 96 this week. So keep an eye on that. And we're Friday tomorrow. Keep an eye on where dollar yen ends the week tomorrow, because it would be interesting if dollar yen would close above 130, let's say. That is going to be monitored relatively closely by the Japanese accounts. Couple of other things we are watching here this morning. Cable on the really short term looks like 123.5 is going to be our level of the George for are we going into positive territory on the day, or are we staying below? If we stay below, why not get a move back down to 123 the figure, or even 122.5. If we are above, then we should be talking back of 124, and then yesterday's highs, which are starting to look as multiple tops. If ever 124.5 goes, then we may start to have to talk about 126s. But I'm not sure that on the day we will have enough strength to pick a side. What do we have this afternoon? Building permits, housing start, jobless claims. People say that I've read people saying that jobless claims are going to be very important, but I don't know. In the past few weeks, jobless claims have always been pushed back by other more important data. So, but anyway, keep an eye, I think, on the 123.5 in the euro dollar, in the cable. Sorry, euro dollar, same. 107.70, 107.90 to watch, and then my magic. Oh, we're having again issues with the recordings.
Come on, Ryan.
Yeah, that's what's going on. I click the chat button to open up the chat because it closes every time Tom takes the screen, and it clicks the stop recording button for some reason.
Really? Wow.
Okay,
so we tried yesterday, as Ryan and Stell already said, to break 108.70. We went up into the 90s, but stalled there again. To me, the magic level is still 109. Other people are looking at 109.40 because they take this prior high but I think the real move started here, and I still prefer looking at this is where Fed started to pivot. So that is the real move for me, at least. Other people can look at this 109.40, and then the 109.40 will appear as a 50% if you take the this high here. the euro dollar. But to me, the magic level is still 109 because it's supported as well by this trend line, which also played a big role on the way down. And in the short term, I've already shown a couple of things happening overnight on the Aussie and the Kiwi. So Aussie bad data, and the Kiwi got a bit of a knock on the head when Ardern handed over her resignation, which takes effect in early February. Anyway, Aussie Kiwi came down to the support here around 107.40. It's also a bit of a support if you look at the prior trend line, which I think is a bit fragile, but anyway, it creates a bit of a confluence here in the 107.40 zone. If ever this goes down, because we also have had traffic there in the past on the way up or down, or so this is going to be important enough. The one below, it should be around 107.10 on the Aussie Kiwi, where I may start to look at rebuilding a bit of the longs I had all the way up, which got stopped below the 108.80 the other day, which is an important level in here, which we have discussed in length. Have a look at 108.25. That's going to be the first decent resistance there on the Aussie Kiwi if you're trading it. I know a lot of people are a bit short right now, which is obviously the right way to be just for now, for as long as 108.25 caps. If that gives way in turn on the other side, perhaps this move will have been seen as corrective, and we can start to move higher again. For the time being, the jury is out. I've got nothing. Let's see what the price action does. MEX. Yesterday we were talking about this, especially in our room. We were talking. I was highlighting as well this important zone where we were heading into. Not only the bottom end of the channel, a bit of an extension, but also the pre-pandemic low of the dollar mix. 1850 is going to be a bit of the magic number. We've also seen it has been a zone of clear interest in the past. So keep a close eye on this 1850 in the dollar mix if ever we get a retest. In the meantime, it held rock solid, and we already started to really correct quite a bit. The zone here for me to watch is going to be 1905. We have already been, and we're actually not that far away. We are trading around 1896 right now. So keep an eye on this 1905. We could, as we were mentioning, as I was mentioning as well yesterday, even being corrective, unless it stops here already, there is a possibility we are going up to 19.25, and there will be a reassessment time, in my opinion, if we get above or if we reject it. If we reject it, I think no change, and there's a possibility of going back down to 18.5. If we start to break above 19.25, then we may be looking at levels pretty close to 20, in my opinion. So keep a close eye on the MEX for those who are interested. Euro MEX, a bit similar, although less clear in my opinion, at least. This one, here it is. A bit less clear in my opinion because of the euro side of things, but we're getting closer to first resistances here. 2060, I would say. We've already broken back above those prior highs, and so there may be some more corrective or at least activity going on in the MEX, just the same as in the dollar MEX. So yeah, if it starts to cap around 2060, that would mean that dollar MEX is probably rejecting above 1900. If not, there's a possibility of this going back into rather the 2070-80 zone if we have to go into the 19.25 or so zone in in the dollar mix. I'm also a little bit reluctant right now because I'm finding euro still finding beats in several crosses. So I'm waiting to see what's going on here. But sooner or later, I may start to look at the downside in this one again. But for the time being, keeping the powder dry. I don't know if you really where you saw that 78, 79 Ryan on the dollar China. Okay, maybe prior highs here, but I don't see much in the dollar China right here, unless you're looking at those highs.
Yeah, it was an old level.
Old, yeah, old here.
68, 6.79.
Right.
Yeah, going back
Okay.
to that area.
Okay. Even in the shorter term, it's capped here before. So yeah, if we get back above 680, it's going to be interesting. And then I'd say keep an eye on 684 here for confirmation.
Yeah. Snap.
Yeah. Sorry.
Snap. Yeah. I mean with a buy stop 69.50. So 79.50. Sorry. So we'll see.
Yeah. Okay, mate. Right. Yeah. So that about the dollar China. I'm personally I don't know what to do with it really. But if we get a move back down to 670 and it holds, then I'm going to get really very interested. So Stell already showed the metals and the yields. So okay, that's good enough for me, I think.
Yeah.
Anything else people would like to look at? Yeah, rejection on the S&P here. 39.10 where we are. We're actually below 3900 here. So keep an eye on this one. 39.10 is giving way. Could be heading back towards the 38.25 zone perhaps. All right, back to you, Ryan.
Thank you very much, mate. That's been a good session. Yeah.
Did I show the euro yen? Because that's the one I'm in since the morning. Did I show you? I don't think I did.
Don't think so.
Now euro yen, together with the rest of some yen processes, is putting in a bit of a rebound here. I've started to shyly enter small long here, and I'm going to play this 137.40. Which is now could be seen as a double bottom, and we are not getting back down there. A little bit like the dollar yen, right? But I find the euro yen perhaps a little, well, personally, a little bit less volatile and perhaps a little less nervous as the dollar yen may be, because the dollar is looking a bit sluggish on the yield side as well, although right now the US 10s is rebounding a bit. But anyway, I've entered a little bit, and I'm willing to add some to my long for as long as need to go perhaps onto the 4 hour, for as long as first of all this level holds, and then I'll be monitoring as well somewhere around the 136s to see if I need to abandon ship or not. But it's a bit of an idea that I'm having, thinking that the yen move, the big yen move at least, may have ran its course for now, and I'm looking for some rebounds, perhaps up into this 140, where I'm going to be reassessing whether to keep it or not, take some off. That is what I'm looking at right now, but I'm finding it pretty interesting. What's going on here, and we can see it in some of the yen pairs as well. Over to you, Ryan.
Thank you very much, mate. Well, I hope we've filled everyone's boots with plenty of analysis and news. Do check out the funding program, and if you're interested in the ForexAnalytix platform, that discount there. Thank you as always to Stell and K-Man for the input, and thank you as always to you viewers for coming and supporting us here at the Flow Show. It's Friday tomorrow. We'll see what that Japanese CPI has brought us. Any more carnage in the yen pairs, and hopefully we go out the week with a nice big bang. So have fun, enjoy your day, make lots of pips.
And I just want to say thank you, Ryan, for being here every day, covering everything, doing such a great job. I mean, it's really fantastic.
Thank you, mate.
You might be an ugly chap.
Are you looking for somebody to buy you the beers on the 7th still?
Exactly. Yeah.
What a good try that was. Well done, mate.
Awesome. You owe me, man.
Cheers, guys. Oh, by the way, I can't make it. Yeah, thank you very much. See you all tomorrow.
Take care.
Hi traders, I'm Ryan Littlestone of ForexAnalytix and ForexFlow Live, and I'm here to introduce you to the Flow Show. Every day in the UK European morning session, we run the Flow Show, bringing you all the latest market news, data moves and events. We make sure that you're informed about what's happening and what's to come that week and each day. What makes us different is that we bring clarity to the fundamentals. We tell you what a central bank comment or piece of data might mean for the price moves and trends you see every day. By nature, I'm a fundamental trader, so I need to know this information myself, and it's what I look at every day to shape my trading decisions. And now I want to share that with you to make it easier for you to understand them and help you learn how they can affect markets. It's not just about me listing out numbers and headlines. We analyse whether there are trends that will change or develop from certain data points, or whether a central banker said something that might change the path of monetary policy and thus prices. We don't stop at the fundamentals though. The fundamentals are just the start of my trading strategies. They create the idea for trades, but then I have to look at the charts to find the levels I'm willing to trade those ideas at. And so that's a big part of the show also. We delve into the charts to look at the tech and how they may help us either plan new trades or to manage current trades. We like to vary from the script too, and sometimes we will have a show that's purely focused on something like trading psychology. Or we may have some special guests on. You just never know who or what might pop up on the show. But that's not all. This show may have my name tag on it, but it's really not about me. It's about you. And so I want to get your input, hear your views, get your questions about all aspects of trading. If you have questions about the fundamentals, the technicals, about learning to trade better, or you simply have a question on what a particular pair asset might do, feel free to come and join the rest of the Flow Show community in asking these questions live in our chat function. So, if you're just a technical trader, we've got you covered. If you're a fundamental trader, we have you covered too. If you want to learn how to improve as a trader, well, we have that covered also. Our show brings you the information in a way that's easy for all to understand and act on. So I look forward to seeing you each and every morning on the Flow Show. Trade well and be lucky.